This article is a historical one, November the 3rd, 2008, and it says despite $143 billion bailout, AIG may be tottering towards collapse. And in 2008, we had AIG being bailed out, Freddie and Fannie, Wells Fargo, Citigroup, Bank of America, and well, the list just keeps piling on. And this page here is the Yahoo Finance income statement or balance sheet. And I'll get to the balance sheet, the income statement, and the cash flow. But it's very, very interesting to see the numbers and look at this 143 billion bailout a little more in depth. You have annual data. We have December 31st, 2009, and we also have quarterly data, which goes back from June the 30th, 2009. But we're going to start off with the annual information. We'll start off with their current assets, which are assets that can be turned to cash within 1 year. The cash and cash equivalents, which of course are already cash, they had what it says here 2.8 million, but these numbers are in thousands. So this is $2.3 billion in cash on December the 31st, 2007. They've managed to increase it. Short-term investments, they had 51 billion in 2007. It went down a little bit in 2008, and it's gone in 2009. And that's very common for many different financial balance sheets on the Yahoo page. Net receivables have been going higher, 42 billion in 2007, and at the end of last year it was up to almost 60 billion. Now they had some pretty big debts and they had some pretty big investments. They had almost $1 trillion at the end of 2007 in long-term investments. What are these investments? It's, I guess, only a guessing game. You would think the stocks that they're investing in, any types of bonds, and any of these credit default swaps or any of these jumbo financial instruments that we hear of today. But quite a large number. Property, plant, and equipment, which would actually be real assets, that was over 5 billion. And interestingly enough, they really expanded their plant and equipment in the year 2009. They went from 5.5 billion in 2007 and 2008 up to over 44 billion. Massive increase. Goodwill, which was 9 billion and then traded down to 7 and 6.2. Other assets, they had about 100 billion in assets. And I don't know what this deferred long-term asset charges are, but we'll just leave it at that for now. As far as current liabilities, these are liabilities that are owed within 1 year. So at the end of 2007, they owed 107 billion in accounts payable. Short and current long-term debt, 13 billion. And the other current liabilities were 263. You can see they don't add them up, but we can do the math quickly in our head. 263 and 170 is 370, so a little under 400 billion they owed. That was the money that they needed to pay off debt, and they got 143 billion to cover some of it, I guess. They had some other long-term debts, some pretty big numbers, but if we look at their assets and liabilities, in 2007 they had over $1 trillion in assets and almost $1 trillion in liabilities. So they've always had more assets and liabilities, which has given them net tangible assets equity to be in the positive. In the positive. Very, very interesting. And yet this company received 143 billion. Now let's just talk about the average person. Let's ignore these zeros at the end, and let's assume that this was our balance sheet. Let's assume I had $2,284 in cash. I had investments worth $51,000, and people owe me $42,000. I have long-term investments of almost $1 million, $807,000. I have my equipment worth a little over 5,000, and I got goodwill worth about 9,400 because, well, I'm a good person. So I got goodwill, I guess, which is why I'm not a big fan of goodwill in the asset book because it just sounds funny. Other assets, I got about 100 grand, and well, now here's the problem. I owe 107,000 here. Well, I owe $400,000. And if I was to owe $400,000 this year, and I have about $1 million in investments, whether it be through stocks, whether it be through buying gold and silver, whether it be through treasury bonds or anything of that nature, you think that they would have taken the money from there. At least that's what would seem normal to me. Moving on, the income statement for AIG. And this is very interesting. In 2007, the company made 110 billion. In 2009, they made 96 billion, and in 2008, they made 11 billion. This isn't real. This cannot be real. How can you go from making 110 billion to 11 billion up to 96 billion? It doesn't make sense to me. Anyway, moving on, we can see here that the company made money in 2007 by the end of the year. They had a profit of $9 billion. And I guess because they had a 90% reduction in sales and revenue in 2008, well, that's why they lost over $90 billion in profit. But how can I put too much emphasis in these numbers when it states the information here of 2008? It just doesn't make sense. Now, as far as their cash flow is concerned, at the end of 2007, this is change in cash and cash equivalents, meaning from the year in 2007, they had an increase of about $700,000 cash than they had from the year ending 2006. Year ending 2008, the year they made hardly any money whatsoever, they had an increase of 6.4 billion. And they got the bailout. Very, very interesting. Now, some other companies received bailout money, like, for example, Citigroup. And we'll take a look at Citigroup's financial statements. This is a company, well, their cash flow, they were losing money. So now we'll go to their balance sheet. And they have some much bigger numbers. You can see how their cash has been a little volatile, we'll say that. 640 billion down to 200, up to 415. That's volatile. And I was mentioning how a lot of these companies' short-term investments just stopped coming into play. Here's another example. Net receivables, they have less receivables. Long-term investments, they went from having almost $1 trillion in 2007 to having over $1 trillion and a quarter at the end of 2008, 2009. And they have 41 trillion in goodwill in 2007, but that got cut down to 27 and 25. More intangible assets and other assets. Now we can look at their debt. And we can see that, they had in 2007, 85. We'll just add these up. That's about $1.3 trillion in current liabilities. Therefore, if we went into all of their investments at the end of the year, you got $1 trillion here, and then your cash, it really should have bankrupted the country. But what's interesting is if we go to this income statement, and let's take a look at their interest expense. Right in here. Citigroup had $77 billion. $77 billion they paid in interest in 2007, which got cut down to 32 and 27. Therefore, the amount of interest they had in comparison to revenue was 77 trillion to 159. Therefore, interest really took away their profits. If we go back to AIG and take a look at their interest that they paid, You can see they had 2.6 billion followed by 2.5. This is quarterly. If we switch this to annual, this company had no interest expense in 2007. Once again, we're looking at these numbers. They had no revenue in 2008, and they really had no interest expense in 2007. But in 2008 and 2009, it was like 17 and 15 trillion dollars. Now let's take a look at Lehman Brothers. Their balance sheet is still on here. The company went under. It says here that LEH is no longer valid, so I have to use this code in here. And we have quarterly data going up to 2008 on this income statement. And the crisis was September of 08. So we'll take a look at where these numbers went from or came from and how they got to the point of their collapse. Their revenue in 2007 it was reducing, and the interest that they were paying, well, they paid a lot. They paid a lot of interest. Let's take a look at this on an annual perspective. And a year before their collapse in 2007, they were able to make money. Net income of $4 billion year end. And their interest expense was $39 billion. Their revenue was $59 billion, and they still managed to make money. And interest, this is money that is created out of nowhere. Banks charge you interest on many different occasions, and when they do this, this creates money to the money supply that doesn't exist, which thus increases debt. But it isn't just the people that get hit with the interest, it's also banks that get hit with it also, as they borrow money from the likes of central bankers, and then they have to pay the interest. But this number is quite large, and if we look at their balance sheet that they had, if we look at their balance sheet and take a look at their annual data at the end of the year, this company had a tangible equity of $18 billion, and the debts in which they had, there was, well, if we add these three together, 80 and 360 is 440 plus 30 is 470. We'll say $500 billion in liabilities. And the assets they had, well, they had that number in long-term investments right in here. So they had enough investments. But what's very interesting is if we look at their debt, their total debt, they have $668 billion in 2007 year ending. So we'll say 2/3 of a trillion to make the numbers easy. 2/3 of a trillion is their liabilities, which covered an interest expense of, say, 39. Now we'll switch this to JP Morgan. Their interest for the year ending 2007 was 23. So that's much lower. Yet if we look at their balance sheet, they had liabilities of $1.5 trillion. So they had more liabilities, more accounts payable, and much less interest than what Lehman had. It kind of boggles my mind as far as their balance sheet was concerned. Once again, like Citigroup, a very volatile amount of cash and cash equivalents. The short-term investments just disappeared, and their net receivables took a huge rise in 2008. Their long-term investments, well, it went up a lot higher. It doubled from 2007 to 2008. It went from 2/3 of a trillion to $1.5 trillion. And their equity, well, at the end of 2007, $71 billion, and then 113 in 2008, and 96 trillion in 2009. And And we were banking these guys out, or bailing these guys out. Very, very interesting. Now, I don't know how real these numbers happen to be, and as far as the mark to market or mark to model accounting is concerned, where is this adjusted? I'm thinking it would be adjusted in the investment section, but I really don't know. And finally, I want to take a look at Goldman Sachs. So we've seen some big numbers here. We see assets of JP Morgan at $2 trillion year ending last year. The Goldman Sachs numbers are not the same way. For JP Morgan had $2 trillion of assets and Goldman Sachs had less than half. And for them, in 2007 they had, let's look at the short-term investments. Because apparently Goldman Sachs are the ones that make all of these trades. They make so many different trades, and if they're day traders, you'd have to think it's a short-term investment, but there's nothing here stating that they have any short-term investments. All of their short-term money is stuck between cash and receivables. Now, they do have some long-term investments, but these numbers are smaller compared to a lot of the other banks were concerned. So therefore, all of the money that Goldman Sachs is trading, where is it? Where is that money on here? Because I can't see it. Looking at the quarterly data, they have no short-term investments whatsoever. None. Maybe it's in long-term. Once again, I'm not too sure. And their equity has been doing very well. They have had positive equity every quarter for the last year, and as far as annual data, they have had positive equity again. That has been going higher, and they even received bailout money as far as I know. I might be wrong. Now, as far as the money that they pay into interest, in 2007 they pay 42 billion, then 31 billion, then 6.5 billion. Very, very, very interesting. Thank you for watching this video and have yourself a great day.